Hello again, traders. Dwayne here from DRFX, Forex Swing Trading. Going to be taking a look at the Euro Kiwi dollar, which on its 4-hour chart appeared as if it was going to provide us with a strong trading possibility. But based on the overall signal that it provided, it now appears as if it has a very low chance of actually providing the movement that we were expecting. Now, to give you the overall context of what I was looking at, here we see on the daily chart of this currency pair that following the return to this resistance point here at 162.36, the market reacted by pulling back fairly aggressively and is now starting to move sideways with the appearance of this small bullish candle. Now, what could be taking place here, which is very common when the market returns to these major resistance or support points, is that it begins to move sideways and form bullish and bearish waves that eventually lead to the formation of a small consolidation setup. So the idea behind the trade that I was looking at today was that I was going to take advantage of this second wave in the form of this bullish movement that was expected to be part of the formation of this consolidation setup. Going on the 4-hour chart. Now, when it comes to the formation of consolidation setups, the market will either be forming a range setup or a pennant setup. So the boundaries can either be angled like this or it can be horizontal like this. But since we can't be quite sure as to what form that boundary is going to take as part of the formation of the setup, I always assume that it's going to be an angled boundary like this, just in case the market pulls back at this area here instead of rallying towards this resistance point. So to be on the safe side and to avoid that type of sharp reversal, I always assume that the market is going to be forming the boundary at a lower point to avoid these types of reversals and to be on the safe side. Now, in terms of the 4-hour chart setup here, what you'll notice is that the market formed a very strong double bottom formation followed by an ABC signal. Now, even though this appears to be a very strong bullish signal, two strong bullish signals, there are two reasons why I'm hesitant about actually considering this as or why I think that this has a low chance of actually rallying. The first has to do with the fact that when it comes to consolidation setups of this size, usually when it comes to the signals that the 4-hour chart provides to start a movement from one side of the boundary to another, the signals generally are not this elaborate when it's starting its movement towards the other side of the boundary. So it will either be a double bottom formation or an ABC setup, and not both. So in this case, we have a double bottom formation followed by an ABC signal, which I think for this size of consolidation is a little bit too much. And what generally happens is that if the signal that has appeared as part of the formation of a consolidation is not in sync with the size of the consolidation setup being formed, then the signal has a low probability of actually leading to a movement. So it's more possible that instead of leading to that movement, the market can become volatile and actually lead to sharp reversals that can take out your stop losses. So for this size consolidation, the signal is usually fairly aggressive. The market generally does not take a very long time to transition from one trend to another. So similar to what got things going for this bearish wave, the market rallied and then aggressively U-turned before aggressively providing us with these bearish waves. So similarly, this is what is expected when it comes to the bullish movement, where we would either see a small setup, a fairly quick setup in the form of either a double bottom formation or an ABC signal, or maybe even a small consolidation setup. It could also take the form of a sharp bullish signal, similar to this sharp bearish signal that started the movement here. So this is the first reason why I think that this has a low chance of actually working out. The second reason has to do with the size of this candle itself that has created this ABC signal. This is much too large a signal when it comes to ABC setups. Usually the signal is of the size like this. A general guide that I like to use is that these types of signals are generally between 2 centimeters to 3 centimeters in height. And anything beyond that usually leads to volatile movements and reversals. So in this case, the market could still respond to the signal, but it has a much lower chance of doing so the greater the size of the candle beyond this standard size for these types of signals. So the size of this candle, coupled with the fact that the market has taken quite a long time to actually start this bullish wave, are the two reasons why I think that this movement has a low chance of actually working out. So what I like to do, what I generally do is to simply avoid trading these types of signals any at all. If I risk 1%, 2%, or 3% on a trade, I wouldn't risk trading it any at all with a risk of say, if I use a risk of 2%, I wouldn't use a risk of 1% or 0.5% just in case the trade works out. It's either a strong possibility of working out or none at all. So there's no gray area for me in terms of whether I trade a setup or not. There's no middle ground. The trade either has a strong possibility of working out or I don't trade the setup altogether. Because what you don't want to get caught up in the habit of doing is trading low probability setups just because you're using a low risk capital. You don't really want to get into that habit. So to avoid that altogether, I would say once a setup has a low probability of working out, avoid it altogether and simply wait until the market provides me with another trade setup on this currency pair or on another currency pair altogether.